Have you ever wondered if your trading can actually make you money? Are you tired of losing money trading and wondering why? It's time to learn the secret weapon of profitable traders, backtesting. Today, I'm going to reveal the ultimate backtesting method that's helped me stay profitable for years. I'll show you step by step how to test your trading ideas to ensure they work before risking real cash. We'll uncover common mistakes to avoid, helping you identify winning methods and maximize your investing and trading profits. What is backtesting? Backtesting is testing your trading ideas on past data. First, it's important because without it, you won't know if your system will actually work. Here's an example of a backtested system. The green line shows how much money the system made. The black line shows the US stock market using the S&P 500 index. This page shows monthly returns and annual returns. The past isn't the same as the future, of course, but testing over a long period of time gives you a very good idea if your trading idea will work. If you do it right, like I will show you how. You can see how much money you can make or lose, depending on the sizes of your trades. Some of you might like to trade by looking at charts. There are some YouTubers who teach about making money from chart reading, but I'm telling you, many of those make money from selling products, not from trading. I'm sorry to say, but it's the way it is. The best way to know if your system works is to test it with clear rules. Question: can you backtest if you use chart patterns and candlesticks? Yes, you just need to turn your systems into rules that you can measure with numbers. For example, candlesticks are just high prices, low prices, opening and closing prices. They're all just numbers in the end, and I've tested candlesticks many times. What tools are best to use for backtesting? I like Wealth Lab. I've used it every day for about 15 years. There are other tools people like, such as AmiBroker, Quant Connect, and you can use Python if you know how to program. TradingView has backtesting also, but it's quite simple. You need a tool that can test a whole portfolio at the same time, not just one stock. Now, I'll show you how to avoid some common mistakes in backtesting and show you the right way to test. As I said, I use Wealth Lab for backtesting, which is this software. If you're serious about trading, it's not expensive. I'm a huge fan of it, and the link is in the description below. I'll walk you through a simple system to show you how to backtest. Like, this system here is not that simple, but it's made 20 times in 12 years, but we'll just go through a simple system. Now, the first thing you want to do is just decide if you want to go for a trend following system or a volume breakout or a mean reversion. Decide what kind of system you want to design, and then on what stocks or what securities you want to test on. And so in this one, we're going to test on the Magnificent 7. So we've got a data set here, Magnificent 7, with Apple, Amazon, etc. We'll test on that. Then we want to check our trading costs are correct, because if our trading costs are wrong, we're going to be too optimistic in our results. So over here we've got the interactive brokers settings. It's actually half a cent a share. I'm being conservative at 1 cent a share. But you can have a flat, $5 a share or $5 a trade, or whatever you like. But we'll stick to 1 cent a share here. Then you want to go back to your system, and we'll start a basic one here, and set the range, the time range. And I always like to include the Great Financial Crisis, the GFC, over 2007 to 2009, so we know how it did in a bad time like that. And of course I always include COVID at the start of 2020. So you want to make sure you test over a wide range. Let's go 2006 to 2024. Then we'll set our position sizing over here. We've got 7 stocks on the Magnificent 7, of course. So 7 times 14 is about 100. So we'll go with 14%, but you can also do as percent of equity. You can also do max risk percent. So 2% of your account per trade, or whatever you like, as per the video I did on trading psychology and handling losses. But let's do a percent of equity, 14%. Back on the trading costs, one thing I didn't mention was over here you've got the percent slippage. That's the difference between the bid and the ask price, so what you can buy and sell at. And you can check that by just watching the stocks trade during the day and see what the bid-ask spread is. And it's a bit tighter at the opening and close when there's a lot of volume, and a bit wider during the day when there's less volume in the middle of the day. So just think when you're going to trade and set the spread accordingly. For market orders, if you do market orders, I'd use the whole spread. For limit orders, I'd use half the spread, because you don't always, when the market's going against you half the time when you get filled with a limit order. Now on very liquid stocks, you probably want to make it more than the bid-ask spread, because the amount you want to buy or sell might be more than what's on the bid or ask. You might have to go down a couple of levels. So now let's just do our simple system here. And we go to the design surface. We've got buy at market, sell at market, so very simple. And so what do we want to do here? So go to strategy, go to building blocks. So indicator crosses indicator. We'll just do a simple exponential moving average cross. So indicator, exponential moving average over exponential moving average. And same for the selling, EMA under EMA, so the opposite. And we'll do, just keep it really simple, 50 days over 200. And of course we make it symmetrical on the exit, otherwise we get kind of lost positions, orphan positions. So, and that's basically all there is to it. Then run and see what happens. We'll just check we've got the Magnificent 7 chosen, we have, and have a look at the backtest results. And that's our equity curve. Of course it's very good because we know these stocks have gone up a lot. But the black line, that's the S&P 500, and we've totally thrashed that. Our drawdown chart, the red shows the peak to trough, how much we lose in bad times. And the black line's the S&P. So in the GFC we lost much less than the S&P 500, but in 2022 it was a bit worse. Then you can see all the monthly returns, annual results. And we can look at annual results here. There's a massive year in 2020 after COVID. And last year we were down 30%, but that shows you the general idea. And then we've got tons of metrics. So 21% here per year over the last, well, since 2006. Pretty solid. Average profit 71%. More stats here than you can throw a stick at. Percent profitable, 52%, but then look at the average profit, 149% is the average profit, and the average loss is just 12%. So what the system's doing, a simple moving average system, is it basically cuts your losses. The average loss is 12%, and it lets the winners run, and that's basically how trend following systems work. So that's a quick summary of using a backtesting software. And as I said, make sure you've got a long time range, make sure you've got your trading costs correct, and make sure the other thing is make sure you're trading on something, you're testing something you can actually trade. Like, don't test trading on the VIX index as I did when I was a rookie, because you can't trade the volatility index, the VIX index. You can only trade futures and options on it, and they move very differently. To make this money, you need to trade exactly like you tested. If you test properly, then trade the way you tested, then you have a good chance of getting similar results as the testing, at least in the long term. But knowing the future is not the same as the past. When you trade, you have to manage your emotions so you can stick to your system. The video up here will be helpful. Thank you for watching, and happy trading.